Hi, welcome to our market update for October 2022. My name's Daniel Rolli. I head up the investment team at Financial Decisions. The last quarter has seen a continuation of volatility that has been a hallmark of 2022. This volatility has been driven by very elevated levels of inflation as a result of constrained supply chains, rapidly rising commodity prices, and higher inflation expectations. Central banks have been lifting interest rates to combat this inflation as higher rates reduce consumer demand, labour market tightness, and ultimately aggregate price levels in the economy. There are both reasons for optimism as well as reasons for caution. Firstly, on the good news side, supply side pressures are starting to ease as bottlenecks come unstuck. As a result, commodity prices have also declined significantly in recent months. Recent share price declines have driven stock market valuations back in line with historical averages. And finally, investor sentiment is very fearful, which is a contrarian bullish indicator. Now on to the bad news. Firstly, earnings forecasts are still too high, and downwards adjustments over coming quarters will likely weigh on stock prices. Secondly, elevated inflation expectations will take time to moderate, given the very tight labour market. This is particularly true in the US, where there are 2 job openings for every unemployed person. We think we are more than halfway through the current bear market based on several observations. Firstly, historical bear markets have tended to last 1.5 years and result in price declines of 35%. This is in contrast with the current market, whereby the bear market is about 10 months old and prices are down 25% from their highs. Secondly, earnings forecasts will likely be revised down by about 10% based on weakening economic growth expectations. And 3, share market valuation multiples are currently more or less in line with historical averages and real interest rates. During bear markets, it's important that we remind clients on several long-term principles for managing, building, and maintaining wealth. Firstly, share market drawdowns are a normal part of the economic cycle. Deploying cash into markets during these occasions takes advantage of these unfortunate opportunities. 2, checking portfolio balances over short periods of time leads to a higher chance of seeing losses, as opposed to checking portfolio balances over longer periods, which leads to a higher probability of seeing gains. Thirdly, quality investments tend to outperform over the short and long term. Fourthly, even the best long-term investments suffer from short-term drawdowns. And finally, timing the market is not a good idea, as about 1/3 of bull market gains accrue in the first 2 months when investor sentiment is at its most fearful levels, as it is most difficult to increase share market allocations during these types of periods of time. We look forward to providing you updates over the months ahead. Please reach out to your advisor if you have any further questions.